Hey guys, it's Brandon here, and we're on site today in sunny, beautiful Myrtle Beach, South Carolina. Now, I'm excited to bring you today's video. I'm excited because we're going to value a business together. Yes, we're going to walk through valuing a small owner-operated business. It's going to be a lot of fun. I'm going to introduce you to three different approaches. The market multiple approach. We're also going to talk about the asset approach, and we're also going to talk about the discounted cash flows approach. Now, we're going to go heavy and deep on two of those approaches. The market multiple approach, you're going to see and learn all about sellers' discretionary earnings and just when to use it, when to use EBITDA, which is earnings before interest, taxes, depreciation, and amortization. But aside from that, we're going to look at the different multiples to sell and value this business at when it comes to the market multiple approach. Additionally, we're going to plug the cash flows in and look at the net present value of the cash flows 5 years post-sale. So we're going to take a look at, hey, what is the buyer going to be able to buy this property for? How much are the cash flows going to be coming into this property on a low, on a mid, on a high, on an exceptional run at this business? And then what is that guy going to be able to sell it for? This way we're looking at both sides of the coin for both the seller and the buyer, and we're pulling out and finding that really happy value right there in the middle so that both the buyer and the seller feel like they have a win. Now, guys, you got to watch the video through to the end because I don't want you to make amateur investing mistakes. There are lots of people that sell their businesses for too little. There are lots of people that have an unrealistic expectation of the market and sell their businesses or list them for way too much and never get them sold and don't understand why. I don't want either one of those things to happen to you. I want you to be a savvy investor when it comes to a commercial property, when it comes to a business, when it comes to Myrtle Beach oceanfront condos. So watch the video through to the end so that you avoid the pitfalls that other investors have made. It's that simple and that easy. And guys, I've had lots of investors on the show. Gosha Cook, who owns 15 oceanfront condos at 24 properties total, some commercial, some long-term rentals. Matt Freeze, who owns 11. That was a lot of fun hanging out with Matt. 11 oceanfront condos. And even Rufia Nigro, who in 17 years, guys, she bought 27 Myrtle Beach oceanfront condos. She owns over $10 million worth of real estate in our market. Now, I have some of the savviest and brightest investors on this channel bringing you the best information so that you're up to date and you know how to make savvy investment decisions, and also so that you know that I know how to do this work for you. So you pick up the phone and give me a call. Now, if you're thinking about investing in a property, whether it's commercial, whether it's an oceanfront condo, or you want to buy a business, or you want to sell your business, pick up the phone and give me a call. It's 843-360-1737. No matter where you are in this process, get a hold of me. Send me over your profit and loss statements and let me do a valuation on your business. Let's start that conversation and get through the hurdles. It's time for a change. Let this be a new chapter in your life. Now, I don't want to hold us up, guys. We need to get into the video. Let's hop into it now. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits, have the highest appreciation, and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years. Whether you have 20% to pay down because you're financing or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better because I'm aiming to give you a 10 times return on your time for watching my videos until the end. All right, guys, so there are 3 different approaches that you can use when valuing a business that is an owner-ran business, a small business that is an owner-ran business. The first one's going to be the market multiple approach. This is going to be based on something called SDE, seller's discretionary earnings, or it's going to be based on EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. I almost left off depreciation there. Anyways, the point is that your smaller businesses are going to rely more on seller's discretionary earnings. Your larger businesses are going to rely more on EBITDA. Now, the second approach is going to be an asset-based approach. I didn't go this route, and that's not going to be in this video because the person who I'm evaluating their profit and loss statements it wasn't an asset-heavy business. If you do have an asset-heavy business, this is a very valid approach to use. And you want to use as many approaches as possible to get as many different vantage points of value. Now, guys, a real quick distinction here between the market-based approach and the discounted cash flow approach. Remember, multiple vantage points. The market-based approach is going to tell you what the market is willing to pay for the business based on similar businesses and what they sold for. You're going to use seller discretionary earnings in this case because the business doesn't have to necessarily be ran the way that it's currently being run. Similar businesses might not use those same exact line items and might not have that same discretionary income, but still are profitable. So seller's discretionary income is going to be used in a market-based approach. Now, discounted cash flows is future-based. It is saying as the business sits under its new ownership, this is what the business can do. It is discounted cash flows. It adjusts for risk. Now, you're not going to use seller discretionary earnings in a discounted cash flow situation because you have a hurdle rate. Like, for example, there's a 22% risk rate in these types of businesses that the discounted cash flow method accounts for. Well, we would be double counting if we use seller's discretionary earnings in the discounted cash flow model, that valuation. So we don't use it. We use net income. We're looking at the business as it sits under new ownership based on its future performance. So we're going to use net income as opposed to seller's discretionary earnings. It's 2 completely different metrics. One is future-based, that's discounted cash flow. One is market-based, that's based on what similar businesses are doing. It's just 2 different vantage points to get an idea of value from multiple vantage points. It's the smartest way to assess how a small business should be sold. So anyways, for this example, I didn't use it, but you can very well use it, and I might do another video on it. Now, number 3 is going to be discounted cash flow approach. This is where we essentially look at the cash flows of the business. How much is coming in? How much did it cost me to get into this business? How much money am I making for the next 5 years? How much money can I sell it for? And then I'm going to discount those cash flows back based on risk. That's called your hurdle rate. And very simply, I'm going to say, hey, based on the risk in this, what are these cash flows worth today? Am I paying more, or should I be paying more? Could I pay less? And we're going to kind of evaluate that. From these 3 different vantage points, we can get a pretty good idea of what this business is worth. I'm going to take us all through that now. Before I take us through it, real quick note. The old school way that brokers provide a broker opinion of value outside of the metrics that I'm using, because obviously I'm a broker and I'm showing you how to use these metrics and these valuation models. But the old school way is to look through the MLS and simply see what similar businesses are selling for. It's that simple and that easy. So you can very well call a broker to value your business. They can look through the MLS, find similar businesses and say, hey, I found these 3 businesses. They're similar to yours. They're selling around this right here, and kind of convert that over and figure out your sales price. Very simple, very easy. So technically there's 4 ways. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the strong rental demand from a growing population. The city's population grew by over 20% just in the last decade, with a significant portion of new residents moving here due to the low cost of living, warm climate, and access to beach amenities. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the tourism-driven economy. Tourism accounts for over 25% of the region's economy. The demand from tourism-related workers ensures a steady flow of renters in multifamily units year-round. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the affordable property prices and high cap rates. With an average cap rate for multifamily properties being typically around 7 to 8%, our market is higher than national averages for coastal areas, offering strong rental yield potential. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the potential for value-add investments. Many properties near the coast have strong locations but may be underperforming due to outdated facilities or lack of amenities. Renovating these properties can create significant upside for potential investors. All right, so let's dive into seller's discretionary income. That's that market multiple approach. You can see on your screen there, I have 3 years worth of net income. Now, in 2022, 2023, and 2024, I did not include 2021. It was a startup year, and the income was skewed. It was a major outlier. Technically, it would have skewed our data. It wouldn't have shown well. So while valuing your own business, you might not want to factor in the startup year if the income's super off, because we want to see more consistently what that business is performing. That way we can have a really good future guess. I took the first year out because it would have skewed our data. Now, 2022, your net income was $44,527.78. 2023, your net income was $71,949.03. 2024, your net income was $26,679.35. Now, you have to add in owner salary and wages, you have to add in interest, you have to add in vehicle expenses, and you have to add in entertainment. All of those things plus the net income are going to lead you to what's called the seller's discretionary earnings. Now, you're probably asking, well, why do we use seller discretionary earnings? Good, I'm glad you asked. Now, it normalizes for the current owner. It adds back owner salary, perks, one-time and non-operating items, so results reflect transferable earnings, not the seller's personal spending style. It's comparable across deals. 2 cafes with different owner pay and write-offs become apples to apples once you convert to seller's discretionary earnings. So it more easily allows you to compare businesses. All right, let's understand what I mean by apples to apples, getting these businesses to apples to apples. You have one business that has a $300,000 net income. You have another business that has a $200,000 net income. But in the $200,000 net income business, the owner is only paying himself $25,000 a year. In the $300,000 net income business, let's say the owner is paying himself $75,000 a year. Well, if you're looking at buying both businesses, you would want to know that, because what if you're only interested in what if you don't need to make any money for the first 5 years that you own the business, or the first 2 years, whatever? The point is that is very valuable information, because that's something as the new owner you can move around, you can be flexible with. So we want to use seller's discretionary earnings to pull out all of the expenses in each of these businesses so that we can compare them equally, so that we can say, all right, well, in this business, I wouldn't have spent $10,000 on entertainment. I wouldn't have paid myself $25,000. I wouldn't have, interest to the tune of $5,000, blah, 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 blah. And in this other business over here, I wouldn't have paid myself $50,000. I wouldn't have had interest of $2,000. I wouldn't have had, and we pull these discretionary items out of both of these businesses so that we can equally compare them apples to apples. That's the point of using seller's discretionary earnings. Additionally, it matches the buyer's profile. Main Street buyers typically step in as the operator. Seller's discretionary earnings shows their potential take-home before debt service and taxes. Obviously, if I was stepping into the shoes of running this business full-time, I would want to know what that take-home number is. Now, simple to value. Market data, Biz Buy Sell brokers. There's a website called Biz Buy Sell. It's a great place for businesses to be brokered online. If you're interested, check it out. Biz Buy Sell, just Google it. It's one word. Now, anyways, it's simple to value. Either through Biz Buy Sell or brokers, commonly quotes both of these commonly quote seller discretionary earning multiples, making pricing and negotiation very, very straightforward. Additionally, it's useful for lending screens. Lenders and brokers often start from sellers' discretionary earnings to assess cash available to cover debt, then adjust further as needed. It's a very, very simple metric that I can run on a business to go, all right, if I add financing to this deal, does the business still cash flow? Bing, 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 because 90% of the buyers out there are going to be using financing to purchase the deal. Now, in this particular scenario, the buyer is not using financing. They are going to buy it all cash. But if I want to do that back of the napkin math, I simply add up these items, then I run an amortization for a loan for this business, and I plug it into the seller's discretionary earnings figure. I subtract out the principal and interest, and I go, okay, they've got money left over. They're still making a profit. They'll be excited about this. Or, hey, they're negative. This business can't support the mortgage. That simple and that easy. All right, seller's discretionary earnings versus EBITDA. When do you use each one? Now, I briefly touched on it, but let's get a little bit more granular. Essentially, a business that's less than $3 million, that has one location, no professional management team in place, you're going to want to use seller's discretionary earnings. Now, for EBITDA, earnings before interest, taxes, depreciation, and amortization, once there's management team in place, the buyer isn't going to be replacing the owner's labor. At that point, you're going to want to use EBITDA, or for larger, lower middle market deals. It's that simple and that easy. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because our market has been the fastest growing market out of the 150 most populated markets for the past 3 years. Over 90,600 people relocated to Myrtle Beach, South Carolina in 2023 alone. This means increased demand for commercial space like retail, multifamily, office, and industrial, and ultimately excellent annual profits and appreciation. Now, for retail, more residents equal more consumers equal higher rental sales potential. This drives up rents and occupancy in retail centers. For multifamily, higher population boosts demand for rental housing, pushing rents up and lowering vacancy. Now, for office, job growth typically follows population growth, increasing demand for office space. For industrial, more people means more consumption and e-commerce activity, increasing warehouse and last-mile logistics demand. Ultimately, the return on investment impact is higher rents, lower vacancy, and rising property values that drive higher net operating income and appreciation. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially oceanfront hotels in the hospitality industry, because of the 20 to 22 million tourists that visit our market each year, which is the number 2 vacation destination on the East Coast. High tourism equals steady demand, making it one of the most visited beach destinations in the United States. Our oceanfront hotels benefit from consistent seasonal occupancy, premium nightly rates compared to inland properties, and repeat visitors, including families, snowbirds, and golfers. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories. All right, so let's dive into that 2.0, 3.0 seller's discretionary earnings multiple that's used in this industry. You'll see here, Biz Buy Sell, they have over 8,000 plus sold restaurant comps that back up this multiple range. But we're going to get more specific. If you look on your screen at the peak business valuation, it says here, Coffee and Snack Shops reports seller discretionary earnings multiple range of 2.03 to 3.26 for this category. Well, our ranges for our valuation fall in that 2.0 to 3.26 category. You'll see a low and a medium and a high on your screen. Let's just dive into that real quick. You take the average seller's discretionary earnings, which we got right up top there by averaging the very far right column on your screen. It's 85,437.71. We multiplied it by an industry multiple of 2.0 to arrive at a low valuation of $170,875.42. We have an average, in the middle there, you have an average seller's discretionary earnings of $85,437.71 with an industry multiple of 2.5, giving you a midpoint valuation of $213,594.28. And finally, we have a high seller's discretionary earnings valuation there, and our average again is at 85,437.71. Our industry multiple is 3.0. That high valuation is $256,313.13. Now, you'll also notice on the right side of the screen that I recommended that the purchase price be $300,313.13. The reason why is I've also looked at it through the discounted cash flow approach, and I recognize that we left a little bit too much on the table when valuing it from a different vantage point. So my recommendation is to take that high valuation, that 256,313, and add some of the cash flow, the profits that we left on the table when evaluating it through the discounted cash flow approach back to the purchase price to kind of meet in the middle, if you could say. So that way the buyer still feels like he's getting a good deal and the seller is getting a more fair price. It's more evenly laid out. So let's dive into that math now. All right, guys, let's roll with it. Now, currently the business is worth at best $256,313.13 based on the market multiple approach, in my opinion. However, in my opinion, again, you have to take into account what the business can do, because certainly that is certainly a value to the buyer for sure. Well, we want to cash in on what he's anticipating being able to make while running that business. It's just smart. If it's valuable to him for what he can do with the business, well, that value we need to capitalize on. We need to find out what the buyer is valuing and tap into it so we can make money on it. That's how it works. Let's just backtrack. I want to read that to you. It says, however, in my opinion, you have to take into account what the business can do, because that certainly is a value the buyer is anticipating. Well, we want to get paid on that since the buyer thinks it's valuable. Here's a table of compound average growth rates. These are the rates the business could grow at under the buyer's leadership. You'll see on the table, we've got a low. It could grow 0 to 2%. For our low, I use the 3.68% that it's already growing at, because It's already there. There's no point in having a lower valuation. Obviously, it could go lower under his leadership, but I doubt it. All right, medium 3 to 6%, steady execution, modest price per mix, better marketing, delivering catering, add-ons, small efficiency wins. If they just do those changes to the business, they'll grow it by 3 to 6%. On the high side, 7 to 12%. Well, strong share capture or capacity increase, more seats, hours, or a throughput, successful product extensions. Obviously, they got to get a little bit more involved in their business in order to make those things happen. If they can capitalize on those items, they can grow that business 7 to 12%. And then there's exceptional. That's that 12 to 20%. Typically requires step changes, second location, major remodel, channel expansion. It's rare to sustain with only one location. Those are our metrics. That's how this business is going to play out over the next 5 years. Those are the things the buyer is looking at putting into place in order to grow this business if he's a savvy investor. Now, let's dive into the discounted cash flow. All right, discounted cash flow, guys. Now, we got our years there, 2022 through 2024. We've got our net income, and then we've got an average net income. That average net income is going to be the basis for our projections. Now, currently, this is where the business is. You can see year one, 49,474.77. Year two, 51,295.44. This projection assumes a 3.68 compound average growth rate. Now, in order to come up with that compound average growth rate, you simply take the ending number, you divide it by the beginning number, and you raise it to a power of 2 because there's been 2 years, essentially. Then you're going to minus 1. That's going to leave us with that 3.68%. So each one of these years, we started with the average net income. You can see the net income numbers are a little bit all over the place. You got 44,000, you got 71,000, you got 26,000. Well, as an owner, where in the world is this thing going to land? It's all over the place. It's high, it's medium, it's higher, it's lower. What's my baseline? Take an average. So we started with average in year one, and then we projected out a 3.68% compound average growth rate each year over the next 5 years in order to come up with that low scenario of what the business should be making on the net income with its current growth rate. Then we went and applied this same logic to all of the other projections. The mid, we have the low net income, we have the mid-level net income, we have the high net income, and we have the exceptional net income. And you can see all of them are just a little bit different, and they increase based on 20% for the exceptional, 12% for the high, mid-level 6%, and of course that low end is at 3.68% that it's currently growing at. Now we ran all those different projections at all those different scenarios so that we can get a good idea where this business can fall in the next 5 years, assuming that it grows. The guy who buys this property is buying it to grow it. In his mind, he's probably thinking he's going to do high or exceptional on it, which is great. We want him to. Now, let's play those out though. We want to know, basically, we want to know exactly what he can sell this business for in year 5. If we can figure that out, then we can get the discounted cash flows because we know what he's going to pay for it. We know what it's going to make every year based on the projections at each different scenario. And then we can figure out, if we know what his year 5 net income is, we can figure out what he's going to sell this business for. Now, here's the potential sales prices at the various levels of compound average growth rates. I had to adjust for projecting by converting net income to seller discretionary earnings using the median historical seller's discretionary earnings divided by net income uplift from your P&Ls for 2022 to 2024. That number, that ratio I used, that number I used was 1.699. So ultimately, I had to look at the historical numbers, find out what the historical seller discretionary earnings divided by net income was. Then I had to take the median number of seller's discretionary earnings divided by net income to use and multiply against my projectionary numbers so that I could come up with what those sales prices are. Now you can see at the low end, 3.68, you got a year 5 net income of 57,169.41. You're going to multiply that by the 1.699. That's going to give you 97,130.83. Now, times that 2.0 multiple, which is at the low end of the spectrum for selling a property in this field. Yes, you have 194,261.66 times 2.5. You have 242,827.07 times 3.0. You've got 291,392.48. Now, you can run these different scenarios at the 6% growth rate, at the 12% growth rate, and at the 20% growth rate for all of these year 5 net incomes. And you can find out the range of where this property is going to sell at in the future. It's that simple and that easy. Now, pay attention because we're going to dive into those discounted cash flows. All right, now pay attention because it's time to figure out exactly what this buyer is going to be able to sell this property for, this business for in year 5. So we simply took those cash flows and we plugged in that purchase price. He's going to be buying it for that 303.13. Now that number is the number I gave to her originally. It's that 256 high valuation plus about $44,000. And I'm going to show you how I arrived at that extra $44,000 in just a minute. Now, then we've got the cash flow for year 1, 2, 3, 4, and 5 based on the high scenario. That's the net income based on having a 12% average, a compound average growth rate. Then we've got a sales price on the high end 5 years from now at that 12% scenario. That's going to be $428,641. So he's got to come out of pocket with a negative 303.13 to get into this business. He's going to experience those 5 years worth of cash flows. Then he's going to sell the business for $428,641. Now, I've estimated a 22% hurdle rate or risk rate. The risk on these businesses on the low end is 22%. On the high end, as much as 35%. I've assumed a low level of risk. Now, I plugged in that hurdle rate at 22%, and what this net present value of these cash flows tells us is that technically he could pay another $41,537 for this business, and he could still achieve that 22% hurdle rate. So basically, he's getting a good deal. He's buying this property or this business technically with about $41,000 worth of equity in it should it perform based on the assumptions mentioned in this video. So instead of giving her the low valuation at $256, I gave her the $256 plus about $40,000 so that the buyer would feel like he's getting a good deal, so that the seller would feel like she's getting a good deal, and they're both winning. Now obviously, the buyer is not buying this property or this business for it to perform low or for it to perform mediocre. He's buying the business and going to spend his life running the business so that it does hit that high and that exceptional growth. And that's how we've positioned this sale. It's that simple and that easy. Very easily, this business is easily worth $303,000. As I get calls, emails, and texts all the time from investors in our market looking to buy oceanfront condos, perhaps you're interested in a commercial property. I recently got a call from another investor interested in buying a commercial property. I do commercial, I do investment oceanfront condos. I can run all your numbers. If you want to sell a business, whatever it is, guys, when it comes to real estate investing, whether in short-term vacation rental properties or commercial properties, I'm your guy that can run your market analysis, run all your financial analysis, and make sure that you're making a savvy investment decision. Pick up the phone. Let's get over your hurdles. Let's stop being afraid. 843-360-1737.